Good morning and welcome to another morning live with Real Estate Mindset. I got a lot of great things to cover today, things that we haven't talked about yet. You guys are going to be, I think, really excited to be, doing this video with me. But before I begin, I got some really big announcements to give to you guys. I bought a house. I did buy a house, you guys. I wanted to be clear about that. So I did buy a house over the weekend. I settled. So I don't even love the house. Here's the thing, you guys. I just want to move on with my life. I don't know if the housing market is going to crash. And I just figured, you know what? I can afford the house. So I bought it over the weekend, which brings me to my next thing, you guys. Happy April Fool's Day. Happy April Fool's Day. You think I'm really going to settle after waiting 2 years and building my purchasing power? Do you guys really think I'm going to do that? I see price decline right now in my market. In fact, every month that I wait, I find a better deal. So April Fools, that was for you. Don't move to Texas. I almost was going to do an April Fool's thing. But anyways, guys, a couple announcements. We're going to dig right in here. A lot of stuff to cover. Now, the first thing that I want to tell you guys is I'm going to be switching my Monday morning lives to Tuesday. So I'll be doing them Tuesday and Friday. The reason I'm going to not do Monday and switch to Tuesday is so we can have one business day go by so I have more to cover with you guys at the beginning of the week. And then let's see here, you guys. And then also, if you guys could do me a favor, at the conclusion of this live, go to the comment section, comment bonkers, because I'm making a new intro and I want to put you guys in the new intro. Hopefully this week I'll have that new intro. Obviously, big shout out to all of the members of Real Estate Mindset that are empowering themselves. We now have 1,474 people that have enrolled to the home buying course. And if you've enrolled to that course, which is in my description, it's free, you're learning how to increase your purchasing power and you're learning how things work behind the scenes in real estate, which is really what I'm trying to show you guys. The more that you guys understand what's going on behind the scenes in real estate, the better off you're going to be, because again, remember, you guys, you can't lean on the professionals. They're absolutely toxic. Okay. So also I got some great interviews this week. You guys are going to be getting a ton of interviews. I got Jack, Melody, Danielle DiMartino. So a lot of interviews, but we're going to get started right now, you guys, on the mortgage update. And before I really jump into the data, I want to bring up this form and I want to remind you guys, because we've been talking a lot about this. Remember, you guys, when it comes to mortgage rates, what you need to be paying attention to is the pricing. It is the pricing, how much it costs to get a mortgage rate. That changes every single day. I'm going to show you guys right now. So remember, this is what this looks like. Okay. This is a rate sheet, okay, or a pricing sheet. So this is a rate sheet. So if I'm a consumer, I'm buying a house, I'm asking my loan officer every single day, hey, what are today's rates? What I'm really asking for is, how much does a 6.25 cost today? Right now, when you're looking at this, guys, here's what really matters to you. Only two columns as a consumer are going to matter to you. Okay, so this column and this column, which is your interest rate and the pricing. So interest rate versus pricing is what you have to pay attention to. Now look at 5.875. The cost based on this loan amount, and the loan amount is like 560,000. So the cost today, right? This is hypothetical. The cost is $12,000. So if you want to get a 5.875, you have to pay $12,000. That fee of $12,000 is known in the industry, and as consumers, as a discount charge. Okay. Now, likewise, if I were to get a 6.5%, okay, I would get a rebate. I would get money from the bank. So the bank would pay me $1,425 to take the highest interest rate. Now, as a consumer, generally what you're looking for is something called par pricing. Par pricing is where the interest rate doesn't cost you guys any money. And so you guys can see here with the pricing that, quite frankly, you guys, there's no par interest rates. It's very hard to get par interest rates in this environment because of how whacked out the trajectory of the interest rates are. So look at the closest to par I can get on this rate sheet is 6.375. And that's still a cost of $712. In other words, you guys, just understand what you're looking for if you're going to go into and start locking your interest rate, is my point. Okay, so again, remember, it's price. Okay, so it's price. And what I'm going to show you guys now is, let's look at the economic calendar. So here's what's happening this week. Oh, Jack, I really Jack, I'm going to save your comments. You guys kick some comments during the videos. I'm going to do a Q&A at the end of the video, as I always try to do. So I really appreciate that, Jack, and I'm going to acknowledge you towards the end of the video. But here's the economic calendar, you guys, and I've highlighted just a couple of things that I'm looking for. Tuesday, we have job openings. I'm going to be taking, basically, I want to know what's going on with the labor market. I want to know everything there is to know about the labor market, because that is hugely tied to the housing market. Okay. Now, Wednesday, we get ADP employment numbers. Wednesday, obviously, Jerome Powell speaks as well. Now, Thursday and Friday, I'm really looking forward to these reports. Thursday, we're getting initial jobless claims at 8:30 a.m. I believe that's Eastern. And also Friday, we're getting a lot more employment information. It's unemployment and employment information. So we'll get non-farm payrolls. We'll get U.S. Unemployment rate, U.S. hourly. So a lot of employment type stuff that is happening this week. So pay attention to that, y'all. Now, this is interesting. Now, take a look at the trajectory. I am surprised. I am surprised by this. This is massive, you guys. I would have changed the title of this video, and I would have got haters in my comment section, because I would have put the title as mortgage rates skyrocket today. I would have got all the, hey, you just skyrocket or plummet, make up your mind. Well, it depends on the day. Sometimes they go up, sometimes they go down. I got to use, colorful adjectives. But you guys, right now, the 10-year is skyrocketing. Maybe it's because of gold. I don't know. Shocking to me. Maybe you guys know. I'm not 100% sure, but 4.288%. That is massive. Interest rates are going to be back in the 7% today. So if you're out shopping like my customer, man, that sucks. You don't know when to lock, right? We don't know when to lock. So probably with the market, this is possible. I did not buy a house, Owen. It was an April Fool's joke, by the way. Probably what I think might be happening here is the market is expecting the job numbers to come in hot, maybe, or something along those lines. But that is a massive skyrocketing, upward for the 10-year Treasury. This is really killing people. That 10-year, the longer term of the yields, is really hurting companies. Now, let me show you what is happening with interest rates. Now, I want you guys to understand this is Thursday's interest rates, okay? So these interest rates are not including the trajectory of the 10-year. So again, this is probably going to update, I'm not sure, 1:30, 2 o'clock Eastern time, and this is going to be in the 7%, okay? And it's 9 basis points away. It may be right under 7%, but it will skyrocket upward. Now, a few things I want to point out for you guys as consumers. First of all, the 30-year fixed rate mortgage is sitting at 6.91%. That is for conventional. Take a look at the 30-year FHA. Remember, you guys, FHA is about half a point lower than conventional. And also, FHA mortgage insurance is generally lower than conventional if you're putting only 5% down, or the minimum down, rather. So just remember that. Now, 15 years, 6.48. Look, and it's very interesting. An FHA is lower than a 15-year conventional. Did y'all know that? If an FHA is lower than an ARM, than an adjustable rate mortgage, look at this. I mean, the FHA is the lowest rate out there. That's crazy to me. So anyways, guys, just consider that. But here's the problem. Okay, so the rate's 6.91. Take a look at the total cost of interest. So if you guys get the average loan right now at 6.91, the total amount of interest you guys are going to be paying is almost $500,000. You see that? $441,000 in interest. So, in other words, if you got to rent, it's okay. Take your time, build your purchasing power. Don't let any of these people bully you into thinking you're doing the wrong thing. Everyone does things for various reasons. Okay, so Jeff purchased a house. I think he probably made a good decision. We don't know what's going to happen yet, but my point is, use the data. Don't be clueless. Don't keep your heads in the sand. It's super toxic out there. In fact, it's probably never been a worse time to buy, but there are some subdivisions that do have distressed properties in my market. Now, one thing I want to point out, you guys, is basically the death trap of a mortgage. Okay, a mortgage stands for death contract. So if you guys really want to knock this out, again, all you have to do is you pay the loan down to $304,000, okay, which would take about $19,400 to pay it down to that amount. If you guys paid that down to $304,000 in the first year, you guys would save over $105,000. All right, that is the power of you paying down that amortization schedule early. Now, obviously, Jeff does not have an amortization schedule, so he doesn't care about that. What Jeff needs to be doing is shopping his homeowner's insurance and property taxes, brother. I don't know if you have a homestead. I don't think he has a homestead in his state, but definitely, make sure that those things don't skyrocket on you, since he is an owner without a mortgage. But anyways, guys, amortization schedule, super duper duper bad. Now take a look at the market's anticipation of what the Fed is going to do next. All I care about now is December. This is always wrong, but I do find it intriguing to see what's going on in the market's mind, if you will, which is always greed and buy, right? But what are they thinking is going to happen next with the Fed? Now, this changed from Friday. They are now pricing in a 1% chance of no rate hikes this year. Yeah, property taxes are criminal, Jeff. You see, you guys, I need to make another video on this. In my metro area, Jeff, I have like, I'm not even joking, dude. Listen to what I'm saying. This is freaking crazy. This is another reason why this is not sustainable. Listen, probably 50% of the listings in my metro area, if you go to their property tax assessment, it's like 50,000, like anywhere from $20,000 to $50,000 higher than the market value. They are taxing us in Texas, in Houston, Texas right now, on values that our homes are not even worth. I found a value that was the market assessment was $505,000. The home is for sale for $350,000. So you're paying taxes on $500,000, but you can't even sell it for $350,000. Another reason why it's not sustainable. But anyways, you guys, 1% chance of no rate cuts, 8.1% chance of a quarter rate cut, 24% chance of 2, 35% chance of 3, blah, 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 blah. So basically the market thinks overall there's going to be 3 rate cuts. I'm going to continuously tell you guys this because this is what I believe with all of my heart. That if they cut rates, they're stimulating the economy. Why would they stimulate the economy right now? And Jeff, and you know, here's Jeff, and I always talk about Jeff a lot because me and him talk a lot. But here's the thing, you know, a lot of people's concerns are we can't have higher interest rates because the government can't afford to service the debt. But I've been like, you guys, we need higher interest rates because of the deficit spending. But the thing is, guys, they can afford to have higher interest rates to pay the debt. Look at this. This is the percentage of interest. Okay, this is the U.S. government interest payments as a percentage of tax receipts. Yes, it has been blowing up. So to Jeff's point, and to the bull's point, yes, that has been blowing up. The liability of the U.S. has been blowing up. But look at when we compare, you know, anything before the 2000s. Okay, so from 1980 to the year, so for 20 years, right, we had high, interest payments. So, you know, the last 10 years, yes, it is super high. It did skyrocket. But my point is actually, you know, look at that chart, Jeff. That's interesting. And here's one of the reasons why. Look at the tax revenue has absolutely skyrocketed. So they're collecting taxes. In fact, I paid double the taxes I thought I owed this year, which totally hurt me. But look at this, average interest on Treasury debt. So you see my point here, Jeff? And look at this. This is a good one too, Jeff, to kind of show that we can afford to raise interest rates and service our debt. This is U.S. government interest as a percentage of GDP. So again, looking at the last 10 years, for Jeff's point, looking at the last decade, it's elevated. It's elevated, right? It is way higher over the last decade. But if we look over the last 3 decades, it's actually, what would you say, right at average? Would you guys say? So I would say, again, over the last 30 years, we're right at average as far as like how much money is going from the U.S. government to pay their debt back. And that's the point I was trying to make, Jeff. So, you know, they do have more room. But I definitely always appreciate, all of his perspective. Let me show you guys this. Okay. Speaking of mortgage, look at this. Okay. So a lot of people are like, oh, home buyers are resilient. The housing market's resilient, right? But the reality is, guys, is the housing market's just locked up. And I'm going to go out and I'm going to just say the rates, like, okay, we have so many things going on. I'm going to make 2 claims here. Number one, the rates aren't high enough. The rates aren't high enough because they're not high enough for the inflation being deficit spending. The other thing, guys, is also the high interest rates, even though they need to be higher, is preventing the housing market from crashing so far. Interesting. And I'm going to show you guys here in a minute how many people are locked out from selling. So when they're not locked out from selling, guess what we get? A flood of inventory. I'll show you that data in a minute, but take a look at this, guys. Again, I find this so incredible. This is this is actually boom, boom, boom. Where is it? Okay, so this is our mortgage applications. Look how low it is, guys. So mortgage applications are all the way down here. And I wanted to point out that mortgage demand right now is lower than it was during the GFC. Now, the mortgage applications is like that grayish bars. The orangest line is interest rates. So obviously the higher interest rates, the lower demand. But again, what I'm really trying to point out is mortgage demand is as low as it was in the 1990s. Mortgage demand right now is lower than it was during the GFC. That's what I'm trying to tell you guys. The housing market is suspended. They have, and I got to give credit. Obviously, the story's not being told. None of us have gone through anything like this before, but it's starting to look like, actually, if they do lower rates, and I'm not talking 75 basis points. If they lower rates 75 basis points, I think it's going to be bad. Like there's going to be too much demand that is not going to meet supply. Like demand's going to go up higher than supply. But if they cut interest rates 200 to 300 basis points, well, then I believe supply will exceed demand, because what's going to happen, you guys, if they cut interest rates 300 to 400, say 200 to 300 basis points, what's that mean? It means that you lost your job. Think about what I said. And what does that mean? Okay. What does that mean? It means that you need to be able to qualify right now. Okay. If you don't qualify to buy a house right now, odds are if we do go into a recession, it's going to be harder for you to qualify in the future. And so the key, guys, is to qualify right now, right? Like I can qualify. I know my purchasing power, so that when we go through these harder times, my purchasing power is still intact. Even if interest rates lower, that doesn't mean you can still get money easily. You can have interest rates lower, but credit restrictions skyrocket. So just put this in perspective. In other words, you got to do work right now. Even though, again, it's pretty crazy out there, we still got to be doing work right now. Now, before I move on to our first video, I want to go over real quick just one more thing with you guys, the LE. Okay, so this is another mortgage thing. Sorry, my face was all like super close. This is this is something that every consumer needs to go. They need to be teaching this in elementary school. I'm just going to say it like that. This is so important and easy to understand. Now, this is called a loan estimate, or an LE. This took over what used to be called HUDs, or settlement statement, which we've used since like the 1970s. So this is the new settlement statement, or the receipt for your transaction. Okay, it's called, once again, your LE. Now, consumers get overwhelmed when they look at this. And the reason they get overwhelmed when they look at this is because there's fees everywhere. Look at this. They're everywhere. Look at all these fees. They're everywhere. Okay? Look at this. Everywhere. Okay? I'm going to tell you guys right now, as a loan officer of over 20 years, I think I'm on going into 23 years now, you only got to look at like two things. When you're shopping a mortgage company, and remember, broker over direct lender, when you're shopping a mortgage company, all you need to look at is your interest rate and the cost. And that's all in this section right here, A. This is all you guys need to be looking at, okay? Now remember, this is a loan estimate from a builder. This builder said, if you use my lender, okay, you guys see that? We will give you $5,400 credit. You see that? Okay, if you use my lender, I will give you a $5,400 credit. The only problem is, because unfortunately for them, I'm a loan officer and I know how to read these things very easily. The only problem is their fee is shocking. It's $5,700. And that's actually just their origination fee. They have a processing and underwriter fee. So what this tells me is actually it's $300 more expensive to use this company right off the bat, even though they're giving me $5,400 credit. Okay, now this is maybe confusing still. I'm writing all over this form, but again, guys, just section A, okay? Just remember, section A. Section A, and you're okay. Just remember that, all right? So we're going to get in now to our first video. Let me just make sure this is prepped up. And you guys, as this video is playing, shoot up some comments. I'm going to start saving some comments. If you guys got anything, good you want to ask, or anything, really cool you want to say. Now, the first video is a pretty powerful video. She is a bit bullish, but she's going to cover a lot of stuff, you guys. She's basically saying buying demand is propelled. So I'm going to show you those. I'm going to show you buying demand after the video. So calm down. I'm going to show you. But she's going to go into like what builders are doing to succeed. They're having to drop prices. So it is a good video, but it's a little bullish. But if you guys can, please let me know that the audio is okay.
Welcome back. It was a big week of housing data. February existing home sales out yesterday, surging 9.5%. That was the largest monthly gain in a year. Both February housing starts and building permits rose for the month. That also beat expectations. The Home Builder Sentiment Index climbing for a fourth month in a row, rising 3 points to 51 in March. Joining me now is Mansion Global host and Fox News real estate contributor, Katrina Campins. Katrina, great to see you. Your reaction to this data?
Thanks so much for having me, Maria. A persistent lack of existing inventory continues to drive buyers towards new home construction, and it's fueled by robust demand and mortgage rates lower than last fall's peak cycle. These factors have propelled buyer sentiment, as you just mentioned, above a crucial threshold in March. Now, buyer demand continues to be robust, and I foresee an increase in market activity if mortgage rates continue to decrease. However, buyers are contending with several supply side hurdles, including buildable lots, a shortage of buildable lots, a shortage of skilled labor, and challenges posed by increasingly stringent building codes, all of which contribute to escalating home construction costs. Now, as mortgage rates have remained below 7% since mid-December, more builders are scaling back on reducing home prices to stimulate sales. So in March, only 24% of builders reported cutting prices, down from 36% in December 2023, and marking the lowest share since July 2023. However, the average price reduction in March remained steady at 6% for the 9th consecutive month. Meanwhile, the utilization of sales incentives has remained consistent with buyers, with 60% of builders offering some form of incentive in March, a range maintained between 58% to 62% since September. So, home prices are continuing to rise for the most part, but builders still are offering incentives, and they are more bullish about getting into the market. So we are seeing an uptick in housing starts, which is good news. I still do believe that there are going to be challenges until interest rates come down, because buyers have very low inventory and have the challenge of mortgage rates at the current rate. So not to mention this NAR lawsuit, I think is going to create challenges for home ownership moving forward.
Yeah, I mean, the National Association of Realtors, NAR, agreeing to policy changes to resolve multiple class action lawsuits from home sellers. One of the key changes would impact who pays for real estate agents, those agents representing the buyer. So under the proposed rules, a broker representing a seller can't offer cooperative compensation on NAR-affiliated multiple listing services. If passed in court, these changes would be implemented in mid-July. Katrina, what do you think about this, and how would that change things?
So, homeownership is poised to become even more challenging in an already tough market as a result of this. The repercussions of this lawsuit are numerous and significant. For those cheering the notion that agents have been exploiting consumers, it's vital to understand that this shift represents a regression in the industry by several decades. The progression to the current state originated from individuals actually seeking increased representation in home buying. And so now what's going to happen is basically buyers are going to go directly to the listing agent, right? And think about all the misrepresentation that's going to occur at that point in time. And then think about all of the kickbacks that are going to be given, all of the bonuses. I also think that listing agents are going to actually use buyers against each other to rise, to get an increase in price so that the seller benefits. So I think this is extremely unfortunate. And while people think that it's going to be good for the housing market, I completely disagree. I don't disagree with a buyer's agent having a buyer representation form, but most buyers are not going to want to sign that form because they're not going to want to pay for their agent. Not to mention that you can't finance those costs. So now that's another cost, another closing cost that can't, be included in the home price that buyers are going to have to figure out how to pay for. So home ownership, in my opinion, just got hit again because of this lawsuit.
All right, Katrina, thanks very much. We'll watch that one for sure. Katrina Campins, and you can watch Mansion Global on Fox Business on Wednesday nights at 9 p.m. Eastern with Katrina. We will.
All right, guys, we got some of those. Now, I'm not going to address every comment that I put up, but I'm going to address most of those comments that I put up. So, y'all put some of those comments I just put up were some great comments, by the way. Thank you guys so much for participating. Now, I'm going to go into the real estate section of this video, and I want to start by talking about value and talking about appraisals, because I want to remind you guys how this works. Okay, so again, we're done with mortgages. Okay, so we're moving on now to real estate. Hopefully, I'll have like a little key button I can push to, we're entering the real estate section. But again, remember, FHA is cheaper. Okay, do whatever you want with that. Brokers are cheaper. Interest rates work by pricing. So remember that. And your amortization schedule is a death contract. You will die if you do not do what I'm saying. You will die before you pay the amortization schedule off. Okay, do what I'm saying. I'm just kidding. I'm not a financial advisor. Do whatever you want. Now, let's go into this, guys. Okay, so value part here, going into real estate. Now, remember what I'm always saying. I'm going to zoom in on this map for you guys. The way that real estate works, you guys, I see so many people. I saw one person charge $10,000 to join a real estate club. $10,000. And honestly, guys, I'm going to tell you how these people get rich. They get money and they use simple math. If you want to become a real estate investor, all you need to know is simple math. To become a millionaire, it's just simple math. I would be a millionaire already, but unfortunately, I lost everything in the great financial crisis. So it is what it is. Hopefully one day, and actually, I don't even care if I am or not, but this is how this works, you guys. Real estate is hyper local. Okay, we look at and talk about macro data, but there are deals in Austin that are way overpriced, and there are deals in Austin that potentially are great deals. And then in Anaheim, most of the deals in Anaheim, California are way overpriced, but then every once in a while, a potentially great deal can come up. Now, the way you determine if a property has wedge and cash flow is you do subdivision analysis using comp comparable data. A comp is a house that sold. You guys, this is so freaking easy. So easy. The problem is you guys don't have access to MLS. I hate it, but I have showed you a little bit about Zillow, but this is how it works. So I would do an analysis on, that's a subdivision, right? Here's a subdivision I would do an analysis on. It's all separate. These are all separate from each other. You don't cross paths, okay? You don't mix streams like the Ghostbusters, You don't ever mix the streams, okay? Is that how that goes? Yeah, because of particle accelerator. Anyways, I got to talk about something else before I get in trouble. But anyways, guys, that's how you do it. So I would do a comparison right here. So I only want to look at data on comps that are in this subject property. Same thing here. I only want to look at comps in that subdivision, only comps in this subdivision, only comps in this subdivision. And you guys, it's so easy. But here's the problem, okay? Because this is so easy, guess what? The investors know how easy this is. Home builders know how easy this is. So all they need to do to manipulate an entire subdivision is have only one overpriced comp. If they sell a home to themselves or to an investor that they know for overvalue and they sell it at cash, they screw up the entire neighborhood, one comp. But likewise, you guys, if we have two foreclosures, even one foreclosure sale in a subdivision, that could bring values down as well. Because remember what an appraisal is, okay? This is all an appraisal is just adding and subtracting. It's so easy, but you take the subject property. First of all, you guys, there's several rows here. Each row is a property characteristic, but there are 4 columns. Column number 1 is basically the subject property. Column 2, comparable sale 1, comparable sale 2, comparable sale 3. You guys see that right there? So comp 2, comp 1, and comp 3 are right there. This is my subject property. So they compare this property right here, okay, to all 3 of these. 1, 2, 3. So we're just doing a side-by-side comparison. And that's why a dollar amount is assigned to each characteristic and an adjustment is made. But my point is, guys, only 3 comparables are used. Now, if you're fighting your tax-assessed value, you want to find comparables that have low value, not high value. So if I was fighting my taxes, and I want you guys to look on the bottom, look at these 3 values. Okay, these are 3 net values. Okay, 3 net values. Now, if I'm fighting my tax assessed value, I want the county to reduce my tax liability. Which comp do I use? Do I use comp number 1? Do I use comp number 2? And this, Jeff, this is for you as well. Or do I use comp number 3? Which one do I use, you guys? I want to see someone say it in the comment section. If I'm fighting my assessed value, I want the county to assess my property for as cheap as possible. Which comparable sale do I give them? Okay. The one at 511, 461, or 463. Come on, guys. That's right. That's right. Thank you. Number 2. Well, yep. You guys got it. Boom. Thank you. Thank you. Thank you. Thank you. I feel better. I get so nervous. I'm like, are you guys listening to me, please? Yes, I know, I know that. But why did it take you so long? So yeah, you give them comp number 2 because that has the lowest value. And likewise, you guys, that value is bringing down this appraisal report. And so if I had 2 comps at 461, this appraisal would not have come in at 494. See that? And in fact, if I didn't have comp number 2, if that comp number 2 wasn't on the report, this would be higher. Because remember, you guys, comp number 2 is pulling my report down. Why? Because it's half the size. When I'm purchasing real estate, if I'm a seller, I want comps that help support value, and I want comps that are as close to my subject property as possible. And here's why. Okay, so my subject property is 2,200 square feet. It's selling for like $250 a square foot. Okay, so 2,200 square feet selling for like 511, right? It's down here. It says 511. Okay, but look at this one. This is half the size, but my adjustment is only plus 25,000. Which means they're only giving me $24 a square foot in adjustments. The appraisers do not give you dollar for dollar adjustments when calculating value on the appraisal. Why is that important to know? Well, it's important to know if you're doing any burrs, doing any refinances, any appraisal fights, anything of that nature. Okay, so again, if you're going to use comps, you want to have comps that are as close as possible to the subject property. Hope that made sense, you guys. I'm going to move on to the next thing now. Let me switch here. Let me just set up a couple things real quick. Okay, so here's what I want to show you. So she was all optimistic, right? Like, oh, there's so much demand, buying demand, blah, 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 blah. Now here's existing home sales, you guys. So that's where I want to start. Look at how low it is. So, how crazy, anytime someone says how resilient the house market is, it just drives me crazy because we're at like super low levels of transactions. We have a transaction crash right now. I understand what everyone's saying though. Everyone's saying prices and affordability. That's what everyone's talking about. But look at how low sales are. Sales are like at the lowest, basically matching the lows of the GFC in 2010. But if we go before that, you guys, it's in the 1990s. So not only do we have mortgage, let me show you that again. Not only have mortgage purchase applications in the 1990 lows, we also have existing home sales near the 1990 lows as well. In other words, the housing market is frozen. It's suspended. It's locked up. It's crazy what's happening. I've never experienced this before. It's insane. So we need the inventory. And you guys, again, I'm going to get to the rate locked buyers here in a minute. But before I do, though, I want to remind you guys how important your credit score is and how easy, listen to me. This is very important. This is simple math. This is simple math that can save you tens of thousands, if not hundreds of thousands of dollars. Your credit score is easy to manipulate so long as you don't have any bad stuff happening like late payments and collections. All you really need to do to manipulate your credit score is play the credit card game. The credit card game is called utilization ratio, which means you don't ever want to go over 30% of your credit line. You guys can see that here. Here's 3 examples. The credit line is $1,000 on this card, $500 on this card, $3,000 on this card. The balance is $400 here, which means utilization ratio is 40%. I told you guys, never go over 30, which means this credit card is hurting this person's credit. Now, here's the second one. Look at balance is $400, credit line's only $500, utilization ratio 80%. This trade line is killing them. They're way over 30%. But look at the last one. The last one's doing good. Utilization ratio only 15%. So in other words, you guys, again, make sure you are not running up your credit cards. And if you do, make sure you pay them before it bills. If you wait to pay them after it bills, they're not going to have your updated balance and your updated utilization ratio because whatever's on the bill is what's reported. So if you pay it after the bill, they don't know your utilization ratio dropped, is my point. Now, let's move on to the next thing here, okay? The next thing here that I want to go over, you guys, is price. Okay, I'm going to go over price, and then I'm going to go over those rate lock buyers I was telling you about here in a minute. So price, first of all, I want you guys to look at that chart. What do you guys see there, okay? That's the median sales price for only existing homes. Okay, so we're only looking at existing homes, and what do you guys notice? What do you notice about median sales price right here? Okay, what you should be noticing about median sales price right here is we did not hit a new peak. If we measure peak to peak, because again, we had I'm not saying we didn't have a heck of a rebound in 2023. Okay, 2023, it blew my mind. It blew my mind. I thought we were going to have a nominal decline, not a real decline, but a nominal decline, and it rebounded like crazy. But the thing is, guys, is we did not hit another peak, okay? We didn't hit a new peak. In June of 2022, the median sales price was $413,800, okay? We got close to beating that, but the new peak only got to $410,100, which means there was a difference of $3,700. It is what it is. I'm just saying we didn't hit another peak. Okay, we got close with that rebound. Look at that rebound. And also what I wanted to tell you guys is price values from a median sales price standpoint. Remember, we did an appraisal. That's how you calculate value. But from a median sales price standpoint, home values have been dropping from, and this is existing, this is not new homes. Home prices have been dropping on median from June to January. Okay, they've recently started going up ahead of spring home buying season. But my point is all these people, oh, it's out of control. You were so wrong. To be honest, actually, we were all wrong, okay? Because there was no new high. But again, I will acknowledge what surprised me is this. What surprised me is what happened from about March to June. That run-up right there was an incredible run-up. Okay, I'll be the first person to say that. Now, bringing us back into inventory, let me show you guys how many people are locked on the sidelines right now that want to sell their property. Okay, now again, this is my point in talking to you guys about this. I think that the high interest rates at this point are preventing a housing market crash. I also think that if we have, listen to me very carefully, significant, not 25, 50, 75, significant rate cut, 100 to 200 basis point rate cut, I think we're going to get a flood of inventory. And you can see this from this chart right here. These are home sales that have been lost due to the lock-in effect by quarter, okay? So this is them trying to estimate how many people are on the sidelines that would sell their house if rates just went to, say, 5%, maybe even 4%. You guys ready for the number? Okay, so the total amount of inventory we have on the sideline that would sell their house, they would sell their house if rates were lower, and I honestly think it's higher, but the total is 1.3 million. And then I think we have another 8 million that are trapped upside down in their house, but we got 1.3 million units on the sideline. So let me ask you guys, what happens? Okay. We know that we know that prices have been stabilized. I don't know if that's the right word. Have been going up and went up because of the lack of inventory. So when we have an influx of inventory, again, guys, comment below. What do you think is going to happen? I mean, seriously, what do you guys think is going to happen? I think prices are going to go down. In fact, when we look at 2022, when we had the fastest price decline, inventory active units was only 800 to 900,000. That's it. It wasn't even a lot. Okay, now I'm going to move on to the next thing. But real quick, before I finish real estate section, we're going to move on to our next video. And our next video is going to be about migration. We got to talk about migration, guys, because I've been reading reports. It is boosting the economy. In fact, I think they think it's going to boost the economy about 7 trillion with a T. So we got to start talking about immigration. I don't want to get polarizing. I don't want to get political. I love people, but I also care about my safety, right? You see what I'm saying? So, we'll touch that very cautiously. That's our next video. But before we end, again, I'm going to say this. If you are out there purchasing real estate, people buy for different reasons. People have different metro areas. I think we should all, overall, for the most part, all of us should wait. And we should wait till after the election, preferably after recession, after we know what's going on. But there's a but, okay? There's still 4 million people that bought a house last year. So we still got 4 million people that bought a house. If you do buy a house, please understand the principles of how to buy, because the better you buy with principles, the better off you're going to be during a recession. If you just buy emotionally, you're not going to potentially be well off during a recession. If you buy with fundamentals like wedge, which means you have equity, or you purchase with cash flow, which means you can move away and be fine and not have to sell, you're going to be better off. So look for something with wedge, with cash flow, have no consumer debt. Biggest thing, have the right expectations. And probably the other biggest thing, this is so important. As someone that's been in this business for over 20 years, okay, most important thing, actually, I'm going to say this is the most important thing. You need to have money after you close. You cannot go broke buying real estate. If you guys buy real estate right now and you're going broke, it's very, very bad. One missed paycheck and what happens to you? One missed paycheck, what happens to you? You see, guys, I mean, you got to have money. You got to have money after you close. Okay, so that's my last thing. We're going to go into that video right now. Let me prep this up for you guys. And if you can, let me know that the audio is okay.
House Speaker Mike Johnson sending Senate Majority Leader Chuck Schumer a letter yesterday informing him that House impeachment managers will send the articles of impeachment against Homeland Security Secretary Alejandro Mayorkas to the Senate on April 10th. Johnson urging Schumer to hold a trial, quote, expeditiously, as a massive caravan of at least 2,000 migrants is expected to arrive in El Paso, Texas, in the coming days. Joining me right now is National Border Patrol Council Vice President and Border Patrol Agent Art Del Cueto. Art, thanks very much for being here today. We so appreciate it. Another caravan on the way. How has the border changed since we've spoken last?
It continues to be chaotic. And look, I want to people need to understand, when you see this caravan that's coming up to our nation's borders, it's not necessarily going to be the entire caravan that's going to cross at that one area. Because what happens is the drug cartels, which we've been saying for quite some time, they control where the groups are going to cross. So the drug cartels will strategically split this caravan apart, and then they're going to determine where these groups are going to cross. And it's going to be strategically so they can further continue to bring drugs into the country. That's the way it's been done. That's the way it continues to be done. And again, this administration does nothing to stop it.
So how is that managed? In other words, the drug cartels organize these caravans of people, and then they decide who goes where in terms of the entries, whether Texas or even different areas of Texas or perhaps Arizona. How does that work?
That's exactly how it works. So the human smuggling organizations, they make the deals with the drug cartels, and then the drug cartel leadership is going to determine where they're going to cross it, depending on where the drugs are and what drugs they need to cross. So that's obviously how they can, because they realize when they do this, the majority of the agents, they're going to be distracted. They're going to have to move to one area so they can handle the migrants coming in. That leaves a lot of other gaps open. That's why you're getting, over close to 2 million gotaways. Is what they believe they have under this administration. Those are the people that, they're going that extra step not to be apprehended or even be detected.
That is unbelievable. And these drug cartels are making billions in the process. In a New York Post interview, Border Patrol Union President Brandon Judd warns that the, quote, Biden administration is flying migrants into the U.S. so that the border doesn't look as out of control as it actually is. He said he's expecting an amnesty program in the future to accommodate the millions of people who've already come into the country since the president took office in January 2021. Your thoughts on that? And how often are you seeing flights coming?
You guys hear the audio okay?
Is now flying migrants in. Do you agree that they're doing so that the border doesn't look overwhelmed?
Well, it's a way to play with the numbers. It's a way that people look at it and say, the numbers are down, and that's why they continue to do this. It's the same as, me talking about the gotaways. They don't really know how many gotaways. As I said, they'll flood one area. That's where the majority of the concentration of agents will be. And in other areas, that's where they take advantage to bring the drugs, but also gotaways. But there's nobody there to count the gotaways. So even that number is just an imaginary number. This administration can make up any number they want realistically, because there's nothing factual to show how many there are. This administration ran their entire campaign on Build Back Better. I think right now we just need them to put everything back where they found it.
Are you tired? All righty, guys. So a couple things real quick. I want to pull up a chart, which something that concerns me about what's going on right now. I'll show you that in a minute. But just to respond to Merino Racing, I am uneducated on this topic. Can you buy a house without residency in the U.S.? You cannot. And that's why I really haven't been following migration and things that much because of how polarizing it is. And I hate the division. I even see it in the comments a little bit, but you can't. But the thing is, Marino, what's happening is there's special programs that the government has for migrants. So there's more money printing. In fact, in Seattle, I've heard crazy things like they get money, like, I don't know how much, like $5,000-$6,000. So there is money printing going on in regard with migration, but as far as an actual loan that we can get, no, you have to have a legal visa. You have to prove you're here, legally. So anyways, I wanted to cover that real quick. All right, guys, now let's go on to, real quick. Let me show you this. This is what scares me. Okay. Don't be upset. I'm just telling you, this is what scares me. Okay. I love people. I was a minority in Chino, California. Okay. I was a minority. I love people. But this scares me, okay, because our safety is at risk. And that's really what I'm trying to say. We need a better system for sure. But what's going on right now is not working, because look at the terrorist screening database encounters by fiscal years. You guys, in 2019, we had no encounters with terrorist screening, okay? In 2019. 2020, a little bit. 2021 skyrocketed. 2022, we have, what is that, 400 to 500% increase in terrorist screening. Look at 2023, and I want you guys to think about this. We don't know who's going into our country, and that's what I'm afraid of. I want to love people. I want to help people, but this is the crap that scares me. And I'm not trying to be mean. I'm not trying to create division, but we have to at least acknowledge that bad people exist in the world, and we need to protect ourselves from those people. That's all I'm saying. Okay. Now we're going to go into the liquidity. This is going to be pretty fun. All right. How do I want to show you guys this? This is where I'm going to start. All right. Yeah, this is going to be a good one. All right. I'm going to just start by showing you guys the inversion. Let me just set this up real quick. Okay. So we're just going to talk about the inversion for right now. And then we're going to go on to some like really cool stuff. This is the 10 and the 2 inversion. You guys, this is crazy. We are now, look at this. So we first got inverted. It looks like right here. You see this? April freaking 1st. We started inversion 2 years ago today. I don't know. We may be in a record. We're not in a, I don't think we're at a record for continuous inversion, but from date of inversion, I think we have a new record. I think we're in a new record, longest inversion prior to recession. We hit a 2-year mark today. April 1st was when that got inverted. Friday, April 1st, you see that? That's when it first got inverted. We have a 2-year 2 years with no recession. This is the biggest one of the biggest indicators screaming of incoming recession. Now, look at this, guys. If you think they're going to drop rates, if you think we're out of the woods, we're not. They have to be doing this to us. The expectations of inflation have been going up since the beginning of the year. So they've been losing ground on inflation. This is why I'm saying higher for longer. They may not cut interest rates. In fact, the only reason they'll cut interest rates is if something bad happens. But quite frankly, you guys, we just have too much money printing, and I'll get to that in a minute. But look at this. Even with the money printing, look at this, guys. Now, remember the difference between real and nominal, and I'll explain that when I pull up Jeff's comment here. Nominal is like numbers, percentage. Real, remember this, real is adjusted for inflation. Okay, so real is adjusted for inflation. Nominal is just the numbers. Okay, look at real adjusted for inflation, M2. Did you guys know that M2 has actually been going down for 2 years? Real M2 money supply. And let me just put this in perspective, how like strong the QT is and the lags are just take for. Let me max this chart out. Look at that. Where's another time in history that we had M2, real M2 decline like that? This goes back all the way to the 1959. We've never, ever since 1959, okay, had M2, real M2 money supply drop like this. I find that incredible that M2, real M2 is dropping at the same time that government deficit spending is freaking exploding. How the hell can we have that? How can we have that? How do we have M2 money supply drop? It has dropped like that since the Great Depression. But yet, look at the money. My God, you guys, this is the problem. Okay, this is the problem. This is primary reason why I don't think we've crashed, why our economy has been propped up. It's the amount of deficit spending. I keep trying to tell you guys, during the GFC 2009, deficit spending totaled 1.42 trillion. Deficit spending is like, we got to print money because we don't have money, but we got to print it because it's like an emergency, right? You guys, 1.42 trillion in 2009. In 2023, we had 1.72 trillion. In 2023, last year, the super strong economy, the people in the comment sections that are bullish, oh, you're wrong, the market's not going to crash, they're just whining and crying. Explain to us, please, how can the economy be strong with deficit spending? If they gave this report to elementary school teacher, this would be rated an F and they would fail the class because that isn't real. And if you guys really want to know, in 2023, the growth, GDP growth was 1.6 trillion year over year, 1.6 trillion. How much was the deficit again? Oh, the deficit was more than GDP growth? The deficit was more than GDP growth. We are sitting on top of a house of cards, and they will continue to print. They're going to try to print our way out of it. I mean, that's what's happening here. But look at this, guys. It's not just that. It's not just the money printing. We still have leftover money from the printing that has already happened in 2020, 2021. This is the reverse repo market. This isn't going down anymore for the last, let's see, since the last about 2 weeks. And I can't explain this. I don't know why. Maybe because tax returns. Maybe people are getting tax returns. That's the only thing I'm thinking. But since the last 2 weeks, the reverse repo market has been going up. I thought this was going to be gone by the end of May of this year, but this has gone up 150 billion in 2 weeks. You guys, the reverse repo market. We got a money problem. We got an inflation problem in America. We're starting to get that by now. I know that. We figure this out. We're smart people. Look at this now. Okay. All right. So the bulls. What you're looking at here, bulls, you're looking at median sales price of houses sold in the United States, okay? But this is all houses. The bulls don't like to look at all houses. They're like, no, you can't do that. You can only look at existing. You can't lump it all together. But let me ask you guys something. After a new home sells, doesn't it then become an existing home? After a new home sells, doesn't it become an existing home? So can't we lump it all together and see what's going on in the housing market, or can we not do that? Can we do that? Let's just do that anyway. Let's just see. Look at this. Home values never even freaking rebounded. When we add new homes to existing homes and we put it on this quarterly, the data's here, guys. The data's here. Look at the drop. Look at the drop. So if we really peel through the layers here, what we really see here is we see two separate markets colliding. We see existing homes and we see obviously new homes. Totally different right now until things collapse. But again, you guys, look at it's down. And then when people, and Jeff, but when people say like it's going to be a real crash, not a nominal crash, because of the 70s and 80s, I get it. I looked at the 70s and 80s, things sustained, but look at the savings rate. Look at the health of the consumer. The health of the consumer back in the 70s and 80s was nowhere near as weak. I don't want to say pathetic, but as weak as the consumers are today. You can see this clearly in the savings rate. Look at this. Look at all these recessions. They went through, look at three recessions through the 70s and 80s. And each time during those recessions, consumers were able to save at a double-digit savings rate. Look at 1974, savings rate was 14. I repeat, the savings rate was 14%. That's why I can't compare this. I can look at the 70s and 80s and the housing prices and how it normalized. I can see that. But when we look at the consumer's in the gutter. But what's the but? The deficit spending. Okay, so yeah, the consumer's weak, but now we have a government that's spending like freaking lunatics, you guys. Absolute lunatics. But take a look at this. Okay. Okay, so this is interesting. This is another reason why consumers are messed up. This is the workers' share of corporate income workers' share of corporate income that hasn't recovered. This is basically showing like the wage gap. This is basically showing that corporate greed is now more important than take care of your employees. This is showing us that shareholders are now more important than employees that have worked at a company for 20 years of their life. They're not important. The shareholders are, because if the shareholders are happy as a CEO, that means I get to take more money for myself. Look at the wage gap. Okay. This has been plummeting. As of July 2023, the share is 73.7%. All right. This is going to be linked in here. My point is, it ain't like the 70s and 80s. Now look at the wage growth going into this recession. Okay. We're not in recession yet. I know that, but I'm going to compare now wage growth. Let's compare wage growth from 2016. Let me see if I can zoom in. All right. So from 2016 to 2022, look at the wage growth. All right. 1.1, 3.4, 3.6, 3.7, 2.8, 8.8, 5.3. So what is the average? About what, 3.5? Okay. Look at what it was, guys, in the 70s and 80s. So again, 1 to 8%, but it's mostly about 3.5. Look at the 70s and 80s. Look at this. In the 70s and 80s, look at this. This is 6, 6, 7, 6, 6, 7, 8, 9, 10, 5.5, 4.8, 5.88. The wage growth, oh my God, So the wage growth, way different. People were making mad amounts of money every single year. Every single year. Not this nonsense 1%, 3%, 3%, 2%. We had a 2% wage growth when we had the worst inflation in 2020. Are you serious right now? I mean, what is this adjusted for inflation? You guys see my point? I think you guys see my point. I don't know. I think you guys do. All right. Anyways. So I hope you guys enjoyed that. In other words, higher for longer. The government prints money, you guys. Of course they can service their own debt, right? Of course they can service their own debt. All right, guys, we're going to go into our next thing now. We're going to go into our last video. I saved this one special for y'all. Our last video is on consumer sentiment. Okay. Now I'm going to tell you guys, the reason I'm playing this video is when I had my anniversary with my wife, we went out to eat. I think it was on a Saturday. I'm not sure. We went out to eat and it was near a mall. And I remember when we got out of the restaurant, I looked up at the mall and the whole this was a Saturday. The whole parking lot was full. And like there's people everywhere. And I was like, and I wasn't thinking, oh, wow, this economy is strong. I wasn't thinking that. It hit me like a ton of bricks. That's exactly how I lived my life months before I lost everything. I see the same thing happening that was right now that was happening in 2008, where people just do not want to sacrifice comfort. People want instant gratification. They're going to keep spending and spending and spending until it melts down. At least that's what I felt when I saw that, because that's exactly what I did before I lost everything. I spent, oh my God, I wish I wouldn't have spent all of my money. I spent all of my money, you guys. It was this horrible time. So anyways, here's that video. You guys just save your money, okay? Save your money.
Rick Santelli again. Hey, Rick.
Yes, boy, we have some surprises
Charlton
here.
gets it.
Looking at University of Michigan, these are March final reads, 79.4, 79.4. This is a huge jump. That's the best level since July of 21, and it doesn't stop there. Expectations, 77.4, July of 21. Current conditions, 82.5, July of 21. All three metrics are the best since July of 21, which means in not that many months, we're looking at 3 years since we've seen numbers on Michigan this strong. Now, let's go to what may be the most important part here, the inflation reads. Now, on 1 year, 2.9. Well, the mid-month read was 3%. These are mid-month to final reads, and they moved a lot. 2.9 equals what we started out the year, and that was the lowest level since Dece of 20 to get a lower number than 2.9. If we look at 5 to 10 year, same scenario. We're expecting it to remain at mid-month at 2.9. It moves down to 2.8, which equals September of 23. To find a smaller one, you're looking at April of 21. So these numbers are definitely hot in terms of what confidence levels we're looking at, but cooler in terms of the pricing, which should be perfect for treasury yields to move down.
Okay. So that was our super happy consumer. So I'm going to move on to, excuse me. I'm going to do some Q&As. Don't forget, you guys, when this video ends, go to the comment section and hit bonkers. I'm doing a new intro. Don't forget, when this ends, go and type, not right now, the live comments, but after this ends, hit bonkers, because I want to do a new intro. I want to put you guys in the intro. So please type in bonkers. All right. Now I want to bring up some Q&As that are really, really good. I want to start with Jack. Big thank you to Jack for supporting me, man. That means a lot to me. You know, just the token of that generosity. The consumer is strong. The labor market is strong. Inflation is transitory. You got jokes, Jack. You got jokes already. I'm getting choked up here. All right. Let's just, I read the whole thing. Okay, it's a great time to buy. It's not like 2008. April Fools, he got me. I did not read ahead. Okay, well done, Jack. You paid $5 to get me, man? Props to you. That's something that I would do. Oh, that's so cool. Thank you, brother. Okay, got a comment here from Ray. Okay. I am wondering if we are approaching the end of the line. It sure seems that way. How much longer can we continue? The thing is, Ray, I don't have all the answers, because We don't know the impact of the deficit spending. We don't know the impact of all of the money printing. We just know that there's a crazy amount of inflation. What I've been watching, Ray, well, first of all, I'm watching my own life, right? I'm worried about me. I'm watching my own market. I'm using simple math. Purchasing real estate is simple math, but most people use their emotions. So as far as the end of the line, man, I mean, this is insane. Okay, but when we look at all the data, I think we just need to get to 2025. I think when we get to 2025, I mean, how the hell can this be propped up any longer? People disagree with me, Ray, all the time, but I think we got to make it to 2025. I don't think there is going to be any smoke screen. I think most Americans are going to be able to see what's going on. I haven't heard one thing that would make me want to buy a house. Oh, and let me be fair here. All right. I love real estate. The soonest that I could buy real estate, I'm going to do it. I've been clear with you guys from the very beginning. I am trying to find a home, but I'm not going to settle on a house. I want to get a house of my dreams, and I want to get a good deal on that. Now, as far as the good stuff, Owen, like, obviously appreciation, right? So one of the positive things about owning a home is appreciation. Plus you get pride of ownership. And then I also like the tax benefits. I get a lot of tax benefits from owning a home. Like I can claim my interest on my mortgage and things of that nature. So, and also, Owen, like everyone should own a home. Okay. Everyone should be retire owning a house, at least one house, because it's normally a great asset. And Owen, I want to make clear, I love real estate. And usually we just have to make it through 10 years. Like if we buy a house right now and we make it through 10 years, the house is going to be worth more, right? We could say the house is going to be worth more. My concern from the very beginning, Owen, has been, can we make it through the 10 years being a homeowner? Like what if we lose our job? Are we one of the regular consumers that's living paycheck to paycheck, right? So, but right now, man, it's just so toxic, and I think everyone should kind of just hold off. All right, Clark, the realtor. I tell my clients to always get a loan estimate and find out how much their monthly is before putting in an offer to make sure they can afford it. And I'm going to take this a step further, Clark. I think that consumers should go to the loan officers before the realtors. If you're shopping for a house right now and you don't know what your payment is and you don't know what your out-of-pocket is, you're using your emotions to buy real estate. You don't know how much it's going to cost you. You don't know how much it costs you out of your pocket. Why would you go look at a house? Because you're using your emotion to buy real estate. Clark is right. You need to get your financing in order first. That's why I'm saying if you're on the sideline, it matters how you wait. Credit, income, assets work on your purchasing power. But always shop. Good job, Clark. Always shop and definitely have that handled before you go buy. And then I wanted to reiterate what Jeff's point is. So Jeff's on the nominal crash up, total crash down in real terms. Again, you guys remember what he's saying. What Jeff thinks, and Jeff lives in one of the tightest, most affordable metro areas in the US. That's why I really feel like we sharpen each other, because he's in the opposite metro as me. My metro, I have all kinds of stuff in inventory going on. He doesn't. So nominal, remember, he's saying nominally, the value is going to go up. So like if homes are valued 200,000, they're going to go up like 210. It's going to go up nominally. But what he is also saying is it's going to go down in real terms, adjusted for inflation. And if we adjust for inflation, prices went down for the last 2 years. Real values went down for the last 2 years. But everyone wants to know about nominal, right? I get it, nominal. Jeff, I still think it's going to be nominal, brother. On a nationwide average, we already have nominal and real, but I'm saying nominal nationwide. 50 Blades of Gray. And by the way, 50 Blades of Gray, I really appreciate you participating. Watch out for this guy. He's got some great insights. I see you out there, brother. Thank you for all of the support. The fact that the cost of new construction is almost equal or lower than existing tells you what you need to know about the direction of the housing market. I mean, you guys, I'm telling you, it starts with new homes. Why else would I have driven all the way to New York and California from Texas? New homes will lead the crash. They already are leading the crash. It's down 19.3% from peak. 19.3% from peak. And I already looked at the shrinkflation stuff. Now, this is from Don't Move. Really good guy. You guys should join our Discord group. He's a big part of it. We always kind of clown with each other. He's always messing with me. And we're going to go fishing, Don't Move. Imagine being a teacher with a union 401k, and this is a good point. Property taxes pushes you out of your mortgage affordability, so you sell your house, then BlackRock buys the house from you and puts it in your own 401k fund. That's what's happening, you guys. Don't you think that we need to do something about it or not? Just let it keep happening. Comment below. People roast me all the time, like, oh, you're messing with my American dream. I should own a house and invest. It's like, y'all aren't listening to me. Like, buy a house or two, whatever. I'm talking about these people own hundreds of houses. We already talked. Oh, can a buyer get a mortgage loan from an investor? Technically, all banks are investors, first of all. So all banks are investors. Wondering because I have a family friend who is an investor and was telling me that he can try to get a lower interest rate than banks from his group. Hell yeah, you should try. Why? What would it hurt? It's their money. If they want to let you borrow it, then by all means. But I would definitely caution you. Normally, investors don't want to let you borrow money unless they're going to make money. So why would they? And again, why would they give you, say, a 5% rate when they could take that money and get a 5.3% in treasuries? So be very careful. I know they're family, but I have seen family rip off other family before in mortgage. In fact, one of my first brokers ripped her family off. Her family came to the office and started screaming at her. They had a huge fight in the office because she charged her family 4 points to do a refinance. $20,000. Anyways, so be careful with your family, man. But yeah, you can do that. Okay. All right, Adam. Here's Adam. All right, so I wouldn't listen to anyone. You have to make up your own decision for what fits to you. I mean, this is, even though Adam is just a little bit all over the place this morning, I will say this is what I've been trying to preach this entire time. You don't let other people do the thinking for you. My goals are different than your goals, but some of our similar goals should be wedge, cash flow, having no consumer debt, proper expectations. Like, we can all share that, right, Adam? Can I share that? Is it okay if I share that? We can share those commonalities, but to his point, you can't, you guys, you can't hold on to words, every word that someone's saying. You have to start doing this for yourself, okay? And I have given you some tools to help you, all right? Good point from Austin. Incentives are just price cuts for sellers that refuse to cut their price. That's exactly right. Let me pull up this super chat real quick, you guys. Big thank you, man. You didn't have to do that. I definitely appreciate that. You guys know I'm a little bit sensitive, sometimes even petty, so I get emotional, and I really appreciate that. My Gen X real estate agent was constantly taking me to houses 50K above my limit. I finally told him, I'm a poor millennial. I can't afford these houses. He stopped arguing with me. Be real, push back. You guys, you don't know what you don't know. You don't know what you don't know. You don't know until it happens to you. I'm telling you, there are some good realtors out there. You will be able to know the difference, but there are more bad realtors, really, really bad. I was going to use the bad word. I'm glad I didn't use that. It's bad out there, man. I'm telling you, that's why I keep trying to say, like, here's behind the scenes. This is easy, simple math. You guys have to be careful. I see exactly what he's talking about happen all the time. When I was actively doing loans, 10 loans a month, I would always have people, let me get the max. And then I would always have realtors like, hey, can I get 20,000 more? 50. It's never find something that I can afford. It's always push things to the max, and agents will push that narrative as well. And so there's a house of cards that we're sitting on right now. I mean, think about the appreciation. The appreciation is based on fear and free money. The values of houses over the last 3 years have been built on fear and free money. I don't know. To me, that's not sustainable. Thank you for the support, brother. To me, that's not sustainable. Okay. All right. So real quick, one more, you guys. Actually, I'm going to do one more from Blades of Gray. So another one from Adam. If this is ridiculous. If you want to buy a house, stop overthinking it. Stay in budget and make sure you can afford it. Is that it? I mean, the thing is like, anytime someone says stop overthinking it, it makes me think like they have a hidden agenda. I'm not saying you do, Adam, but when we have a 90-some% buyer's remorse survey, and we understand that this is one of the least known about transactions that Americans can partake in, I would say that America overall has an underthinking problem when it comes to the housing market, especially because look at the new home builder. I'm sorry, not new home builders, first-time home buyers. The surge of first-time home buyers right now has exploded because millennials are like, nah, this is toxic. We don't want no part of it. Yes, do your own thinking, but for someone to say stop, or what do you mean stop overthinking it? Like, don't look at wedge. What do you mean? What do we stop overthinking, Adam? Can you tell me what do we stop overthinking? Recession? Do we stop thinking about our jobs? I mean, what do we stop? How do we know that we can afford it? You've given nothing here, brother. Give us something. This just looks like complaining and crying, and you've been crying all morning. So I just wanted to let you know I see you're crying. All right. Anyways, 50 Blades of Gray. This is our last comment right here. I wonder what the monthly payment cost comparison of new versus existing is. With the rate buy downs being offered by builders, I wouldn't be surprised if the monthly cost is more competitive than existing. Now, here's the thing. He hit the nail on the head. In my market, I see this clearly. I have a lot of new construction. New construction has outrageous incentives, 4.25% fixed rate, 10,000 closing costs, 2021 prices. Existing homeowners cannot compete. They cannot compete with that type of incentive. So if you have existing homes near new homes, again, it's going to spread into that market. I see it happening. We see that happening in Kingwood. I've showed you guys Kingwood. We see Kingwood. I've showed you guys multiple deals with $100,000 in wedge. You guys, here's the thing with the housing market. It's changing right before our eyes. What happens next is hard to tell, but some of the things we don't have to overthink. Some of the things are very clear. Like one thing that's very clear is how overpriced things really are from a historical standpoint. When we use simple elementary school math, we can see PE ratio, payment to income ratio. But the other hand is, guys, and let me tell you guys the point of the bulls, and then we'll get this out of here because I always want to look at all points here. So here's what the bulls that I like kind of respect their opinions, right? Because they've explained it and it makes sense. I understand what they're saying. What the bulls think that is going to happen is we're going to have an additional run up in prices of houses. And that if you don't buy now, this time next year, prices of houses are going to be much higher because there's going to be more inflation, devaluation of the dollar. And so because of all this devaluating in dollar, you got to buy an asset. And an asset like a house is a strong hedge against a recession. And that's what they look at. But what I say is, well, we see the trajectory of defaults skyrocketing, credit cards, car loans, all these other things. We see real wages going down. We see price values going down with new homes. We see inventory going up. My thing is if, say, home values do explode 10, 15%, how can people pay for them? We're hitting a wall, you guys. We're hitting a wall. How could people pay? Okay. Did I make it? Did I make it on? Can you guys see me? That was some people are messing with you. Oh, yep, I'm back. They're like, they got him. What do they get me, man? I'm just trying to help some people. I'm not trying to come on, don't get me. I don't want to be got. I don't want the smoke. Okay. But I did want to come back here and I did want to wish you guys a great week. I hope you guys achieve your goals. I hope you love some people. And the most important thing, I really hope that, you love yourselves, right? Love yourselves. Don't be oh my God. Lose this again. Oh my gosh, you guys. I don't know what I'm doing. Okay. I got some difficulties going on here. All right. So I'm back again and I have an echo. But anyways, I'm out of here, you guys. I get an echo. I'm so sorry. But anyways, I will see you guys on Friday. Don't forget, after this video, shoot me a bonkers. I'm making a new intro. I love you guys. Till next time.